You're watching City Channel 4, your window to our community.
Topic for today, choosing the right tax structure. But before we move on to this topic, there was a couple of questions from last workshop that we have, and I want to address those before we get into this. One of the questions that they have, it was between use tax, consumer use tax, and sales tax. There was a little bit of confusion between those two. So think about it this way. Sales tax, you pay, let's say if you are the business, think about you as a business. Sales tax, you will charge to your client or your customers. That is sales tax, okay? Consumer use tax happen is when you buy something for your own use that you didn't pay sales tax. So that's why it's called consumer. So for example, let's say you go to out of the estate. Normally happen when you buy something out of the estate. Do not happen when you are buying something here. Either you buy online or you go, let's say, to Illinois, and then you are trying to buy some of the office supplies, for example. You go over there because you are from different states, and it's going to be for your own use. They might not charge you sales tax. So what happens is that when you come back to Iowa, then you have to report and pay consumer use tax. Let's say you went to Illinois, you buy 1,000 of office supplies, you didn't pay sales tax. So when you come here, you have to report that $1,000 that you bought, and you have to pay the consumer use tax. Same if you buy online. Let's say if you go to Amazon and you buy something for $1,000 office supplies, they ship it to you, but you didn't pay the sales tax. So when you use it, it's for your own use, right? So when you got it, then here in Iowa, you have to report it, and then you have to pay consumer use tax. So just keep that in mind. It's two different things, very similar. Sales tax is what you are going to charge to other consumer. It's when you use it for your own business use that you were supposed to pay, but for whatever reason, they didn't charge you. So when you are going to, you have to pay it in Iowa. You have to file and pay in Iowa. So you need to fill out an application. It's just the same. You apply for a sales tax permit number, and then if you have too many of those consumer use tax, then you have to apply for one of those permits. It's called consumer use tax permit. Okay? So that is what I want to clarify between use tax and between consumer use tax and sales tax. Those are the two differences. The other question that we have last time was between dance studio, and the question was if for dance studio is a taxable service, and it is. If you are trying to open a dance studio, then you need to charge sales tax. So it is a taxable event. Okay? Okay. Now we can move on to our topic for tonight, choosing the right tax structure. So our agenda for tonight is going to be most common use tax structure. So we are going to discuss all of them. As you can see, we got Soleprop, LLC, Corporation. Okay, those are the three most common ones. And then we're going to discuss about tax reporting, go into more details, and then I'm going to give a couple examples on those. So from here, what you can see is the most common use tax structure. There are many of them. You might hear some of them, but this is the one that they use most here in Iowa. One is the Soleprop, the other one is a LLC and LLP. LLC stands for Limited Liability Company, and LLP stands for Limited Liability Partnership. Corporation, we have two types of corporation. We have the C Corp, and then we have the S Corporation. So tax reporting. I know that we are using some kind of form here. So for example, the Soleprop, you file the taxes on the 1040 Schedule C. The 1040 is the one that you use to file your individual tax return. And then a Schedule C is just a different form that they use for the business. So it's going to be combined. When you file your personal taxes, then you are going to just mention to your tax preparer that you have a business and that you are Soleprop. and that will include that form. It's called a Schedule C. And then you are going to add just your income and expenses. And then if you have a profit, then you pay taxes. If you have a loss, then it's just kind of like a deduction that you have. So for Soleprop, it's going to be reported on the 1040 Schedule C. LLC or LLP. So if it is a single member, that means just one. If you are the only owner of the LLC, then you're going to be filing as a 1040 Schedule C. So if you have an LLC and you use it for rental properties, real estate, then you are going to file a Schedule E instead of Schedule C. Schedule E is only used for rental property. So if you have a house that you are renting, then that will be on the Schedule E instead of Schedule C. Schedule C is more like operation. You know, it might be, if it is a rental property, then might be more like a management company. So that will be a Schedule C. It's more like an active. And a Schedule E is more like a passive. So if you have multiple members, then instead of filing as a Schedule C, then you are going to file as a 1065. 1065 is a special form for taxes for more than one member. So why it has to be a 1065? The reason it is a 1065 is because you can imagine if there is two owners, so who is going to report what, right? So first, you have to do the tax return for the business first. So that is why it's the 1065. 1065 is the tax return for the business. Then after you file the 1065, the tax return from the business, they will give you a form. It's called K1. So on that K1, it will show what is your share of the profit or loss. So it will be based on your percentage of allocation based on, if you are 50-50, then you are going to get a K1 with 50% of the profit or 50% of the loss. It just depends. LLP, always 1065. It cannot be on the Schedule C because that is one of the difference between LLC and LLP is that one of the requirements, LLP always have to do two owners. It cannot be one owner. It has to be two. Because it's two, it will always be as a 1065. So that was I'm showing there. Corporation, if it is a S Corp, it's going to be a 1120S tax return. That is a 1120 form. And then if it is a regular C corporation, we call it just corporation, then it's going to be as a 1120. So if it is a S, it's going to be at the end as S. If it is a C, it's just a regular 1120. So those are the forms when you file taxes. That's what you need to use. Okay? So let's not get confused. So normally if you have any of these, when you do your taxes, you need to mention what kind of business structure you have. Otherwise, sometimes they might get confused and they might be, preparing one of the tax return that is not supposed to. And sometimes there is indications to tell you what kind of form. For example, if you think about, let's see, ABC Company, Inc., that is telling you it's a corporation. It's an incorporation. Inc. stands for incorporation. So a corporation can be a corporation, Inc., or incorporation. So that gives you an idea. The same is an LLC. If it is an LLC, that tells you, it's a limited liability company. So for example, ABC Company LLC. So the LLC, that will give you an idea. Okay, this might be a LLC company. So we might be filing as a single member or as a 1065. The issue that we have is that sometimes you might decide to start a company that is either a corporation or an LLC, but for tax purpose, you decide to reclassify and file different. What I mean by that is that, for example, today you decide to open an LLC. For whatever reason, it's not working out for you. But you don't want to close that LLC. You want to keep using it. So what you do is that you tell the government, I'm not going to file as a 1065 or as a Schedule C. I want to file my taxes as a corporation. So then you go and you tell the government, and the government will send you a letter saying, we approve your request. So from now on, you have to file as a corporation. So even though your name is ABC Company LLC, you might be filing 1120 because you told the government you are filing as a corporation. So even though that is a good indication, that doesn't exactly mean that you have to file that way. So as a tax preparer, we normally ask our clients what kind of entity you have. Or we go based on last year's report. Or normally what happens is that when we try to file the tax, it got rejected. Because the government said your entity type is different from the one that you are trying to file. So it's not the same. So that is why we will know what is the difference. And when we talk a little bit more in depth about each of these, you will see the impact that you have. For example, if we are dealing with a corporation tax return, but we did it as a pass-through, then the personal tax return will change, and it might have a huge impact because you might have penalty for not doing estimate tax payments, or you might have, you might need to change or amend all your tax return because you are filing incorrectly all this year, something like that. So the tax structure that you have with the government is very important, and we will go and look into that a little bit later. So moving on to the Soleprop. That is the easiest tax structure that you can have. As a sole proprietorship, you can go open a business under your name, and then, if you need to have some kind of license, permit, then you just apply. That's it. Nothing else. You don't need to do any registration. You don't need to apply for anything special, really. It just use your name. For example, let's say if you want to start a cleaning company. If you decide to start a cleaning company, if it is cleaning houses, there is nothing special. You don't need to apply for a sales tax. Sales tax is only for commercial cleaning. So then you can just go, knock the door, pam, pam, pam. Then if somebody gives you, a job, then you clean at the end of the year. You file your taxes. You just, tell your tax preparer how much you receive, what was your expenses, bam, that's it. Simple structure. Anybody can open it. The only thing that you need to know if you need to have a license or not. So the benefit that we have is that it's easy to start, operate, and maintain because there is no reporting, only at the end of the year. But if you have an LLC or corporation, you will see that there is some paperwork that you have to have either every 2 years or every year, okay? But with a Soleprop, you don't need to have any of those lower startup costs because it's just you. That's it. Nothing else. You don't need to spend money on anything else. It's just you. You can go, if you open a website, online business, you just register everything under your name. That's it. We hear a lot about Uber, right? So normally they are like Soleprop. So basically they just fill out an application with a name, social, that's it. So they are running business. So that is one of the easiest ones. Quick and simple tax preparation. Why? Because there is nothing special. It's very easy. You only need to have a profit and loss, P&L, income statement, to file your taxes. So technically, you only need to show what is your income or your revenue, what is your expenses. At the end, you will have a profit or loss. That's it. You don't have to deal with, how much asset you have, how much liability you have, nothing like that. It's just very straightforward. Something that you can keep track, you can do it on Excel, on your own, a folder with, with all your income, all the check that you receive, and then the expenses, all the receipts that you have. That's it. Very simple. The main concern or the disadvantage is personal liability. So because you are operating the business under your own name, that means you are personally liable for whatever could happen to that business. So you might get a lawsuit because you did something and your insurance is not covering, so you personally are liable for those. So that is the biggest concern, personal liability. So when you have a Soleprop business. A lot of people, when they start the Soleprop, they just do it just to test the market because they are not very sure what they want to do. or they don't have the budget to start something else. So they might decide just to, start a business with a Soleprop. You can always switch to something else later on. So if you have a motivation and you want to start a business, you can start as a Soleprop. There is some, risk that you are taking, but, you are willing to take those for whatever reason. And then a Soleprop might be the most suitable business structure for you. Very simple. Okay, let's look at the next one. Next one, LLC or LLP, limited liability company or limited liability partnership. This is a business structure that is a hybrid or a mix between a sole proprietorship kind of thing and a corporation. In a sense, the corporation, because you have the protection, you are personally, your liability is protected. So there is a certain degree, that's why it's limited. It's not 100%, but it's limited. To some degree, if something goes bad, then you are not liable for, for the debt or for any kind of liability that you have. And the reason it's a mix between a Soleprop is because it's the pass-through benefit. What is meaning by pass-through is that when you pay taxes, there is no double taxation. You only pay taxes under your personal name. So if you have an LLC and you file the taxes 1065, and then the income, the profit or loss, it will go to your personal. And in there is when you are going to pay the taxes. So it's not going to be under the business level, but it's going to be under your personal level. It is a pass-through. How much taxes you need to pay? Depends. Depends on what your tax bracket. So if you are on the 35%, then whatever income you have from the business, then you are going to pay 35%. If it is 15%, when it passes through, then it's going to be a 15%. So the benefit we have is a legal protection, okay? Enhance business credibility. Why? When you're operating as a sole proprietorship, people ask you, what is the legal name of the business? Your name is the legal name. But when they ask for an LLC or LLP, it's going to be whatever name you selected. It sounds something big, even though it might be so small. But because it has the name ABC Company, Inc. or LLC, then nobody knows how big is this business. So, people tend to rely more on those because they believe it's something that was structured, maybe something bigger than smaller. And then we discuss about pass-through taxes. Because you don't pay at the business level, it will pass through your personal. That's when you pay taxes. The biggest concern is self-employment tax. It's just the same as a Soleprop. You pay taxes on your personal level. When we talk about LLC and LLP, remember if there is one owner or member, LLC, they call it member. So if there is one member, you file as a Schedule C, the same kind of concept, right? So you will be paying self-employment tax. But let's say if there is 3 owners or members, you could be structuring the LLC in a way that 2 of them are passive and 1 of them is active. The passive is like passive investor. They might have contribute capital. You open the business, but they are not active managing the business. So the active one is the one that is active working and managing the business. Okay? So what happened is that the active member, that is the one that has to pay self-employment taxes. But the passive one don't have to. So the passive member only pay income taxes. The active one pay income tax plus self-employment taxes. Okay? One of the biggest difference between LLC and LLP is that with the LLC, you can have a member that is a corporation. You can have a member that is a trust. But with the LLP, you cannot. With the LLP, has to have at least 2 members, and those members have to be a person, individual. It cannot be either a partnership or a corporation. So there's a biggest difference between those two. Otherwise, it's the same. It's just a pass-through income that you have here, or the profit. It will go to your personal. You file taxes, and whatever is your bracket, then you will be paying taxes in there.
Do you still pay self-employment tax if you are holding down a full-time job and having the business on the side, and then are the self-employment taxes prorated, like
No.
percentages?
No. The question is that if you have another, you have a job and you have the LLC, do you have to pay self-employment taxes just because you have another job, right? If you are active, you have to, because it's almost like you are holding two jobs. So in one, you are working full-time, but the other one, you are the one working. You are not passive, you are active. So that means you are working for it. So you have to pay self-employment taxes.
So you just mentioned for LLC,
Mm-hmm.
if there's 3 members,
Yep.
if they're all very active, then what?
So the question is that if we have an LLC and there is 3 members, there are 3 members and all of them are active, then what? So if everybody are active, then everybody have to pay self-employment taxes because everybody is working. So just keep in mind, active and passive. Passive, you don't work for it. You only give you capital. Let's say I'll give you $100, then I'm gonna have 50% owner, but I don't, I'm not involved. I'm passive. So what happened, in the business, you manage it. I'm only passive. I only give you money. That's it. So because I'm not working for it, I'm passive, then I'm not subject to self-employment taxes because I'm not working for it. Only if you are active. If you are active, that means you are working. And then you have to pay self-employment taxes.
Seems like a slippery slope.
No, if you are the one managing, if you are managing the business, if you are making decision, those will be active. Well, rental. Okay, I'll go into that with the next slide. Yeah, so that is one of the biggest difference between active and passive. Active, keep in mind, you are working. Okay, passive, you are not.
But the passive person has to pay when they gain something, money from them.
Well, the question is if the passive will have to pay when they gain something, right? So it depends. The passive will pay taxes or the active will pay taxes. It depends at the end of the year what is showing on the report. So if the tax return is showing that there is a 10,000 profit, even though you are passive but you didn't get it, you have to pay taxes. So that is the pass-through. The pass-through, you pay taxes on whatever you are showing, not on whatever you are getting. Yes.
Are you saying that is to their personal taxes,
Yes.
not the business?
Not the business. The LLC or LLP do not pay taxes on the business level. It is a pass-through. So you file the 1065, either LLC or LLP, then they give you a K1. Let's say you are active, and the K1 will show 25,000 profit based on your share. So let's say you are 50%, so you are getting 25,000. 25% of that 25,000, right? So then it will show in there exactly how much you got. Then you have to pay taxes. It's not like how much you got. Let me rephrase it. It's not how much you got, but how much profit the business have. Yes. So internal reporting, because it's a pass-through, it doesn't matter if you got anything. It doesn't matter if you took money out of the business or you didn't. What it matters is what the business is showing.
So each person pays taxes on
So the question is if the person pay taxes on the whole amount on the cut. The person will pay taxes based on the percentage that was discussed. One advantage of the LLC versus a corporation I'm going to mention here is that, let's say we are all investors here. And we decided that when we have a profit, Dan is going to report 90% of the profit. So when we have a loss, then we are going to share it. That's one of the advantages of the LLC. It doesn't matter what is your capital contribution, how much you put in the business. You can decide what is the percentage of profit each partner is going to be reporting. So you can structure it different. That doesn't mean, let's say, if everybody, let's say we have two people, 10,000 and 10,000, 50 and 50%, right? But you can say, you know what, for you, when there is a profit, you report 80% and I keep 20%. And when there is a loss, then I report X amount and you report X amount. So there is some kind of flexibility in reporting when there is a profit or loss, okay? So I see down here I already moved to the corporation. So on the corporation, like I mentioned, there is two types, right? There is a S corporation and C corporations. And corporation is an entity totally independent of the owner, okay? Let me start by talking about the C Corp first. All corporations, when they start, they are a C Corp, okay? All corporation, when you form it, it's a C Corp corporation. A C Corp corporation is a business structure when the business files the taxes is totally independent from, its shareholder. We see a lot of big corporations. All of those public corporations, they are C corporation. Yes, like Walmart. Walmart is a C Corp corporation. So they will file taxes, and you as a shareholder, what you can get is called dividends. If you get dividends, then you have to report it as a dividend income, and you pay taxes. So on the C Corp is known as a double taxation because you pay taxes on the corp level, and then if you try to get some of the money that you have on that corp, you have to pay taxes again. So double taxation. Okay, let me repeat it. On the corporation, you file the taxes. If there is profit or loss, it's a stay on the corporation. It doesn't pass through anywhere. So if there is a profit, you pay taxes. If you want to take something out of that profit, then it's called dividends. Then you have to pay taxes again. Double taxation in there. So what is a S Corp? The S corporation is very similar to an LLC. S Corp is a pass-through. You don't pay taxes on the corp level, but the profit or loss, it will pass through you personal. Okay, the S Corp is very similar to an LLC. Why? Because it's a pass-through. You don't pay taxes on the corp level, on the corporation, but whatever you have as a profit or loss, it will go to you personal. And then you have to pay taxes in there. So remember, S Corp, pass through. C Corp, do not pass, do not go anywhere. It just stay there.
You have profit you're paying the individuals.
As a S Corp, yes. Similar to the LLC. So what is the biggest difference between LLC and S Corp? Self-employment taxes. Okay, so remember, let's assume the LLC, everybody is active, so whatever you have as a profit, let's say 100,000, you have to pay self-employment taxes out of that 100,000. Okay, so the S Corp, you don't, but there is one requirement. You have to pay yourself as an employee. Because it's a corporation, you have to pay yourself as you were the one working on the corporation as an employee. So let's say, for example, out of the 100,000 that we have, right? And then you pay yourself 50,000 as an employee, then you pay self-employment taxes out of that 50,000, right? Because you are an employee. So the other 50,000, it will just pass through to you personal, but you don't have to pay self-employment taxes. You only have to pay income taxes.
You pay those income taxes if you're LLC.
LLC, you pay income taxes plus self-employment taxes. Because if you are active. But if you are S Corp, let's say, remember, 100,000, you pay yourself 50,000 as an employee, and the other 50,000 is kind of like the profit of the corporation, right? So that other 50,000, it will pass through you. You only have to pay income taxes, but you don't have to pay self-employment taxes. Of course, the IRS know about this, and they don't want you to, you have 100,000, the IRS do not want you to pay yourself as an employee 10,000, and then the 90,000, you don't pay self-employment taxes, right? So when you are S corporation, they talk about reasonable compensation. So you have to pay yourself a reasonable compensation if you have a corporation, S Corp. So if you are the one managing the whole operation, and you have one employee that is maybe on the operational side or doing manufacturing something, and all your employees, they make, let's say, on average, 40,000. You cannot go and you as the owner and managing, a manager, CEO, pay yourself 10,000 because that is not reasonable. So you have to have a reasonable compensation. As long as you have a reasonable compensation, for example, let's make an example that is a little bigger. Let's say the business has 1 million profit. As an LLC, you have to pay self-employment taxes, right? They have the limitation, of course. But as a S Corp, out of that, let's say 100,000, by the amount of time that you put into the business and you're managing, 100,000 might be reasonable. Maybe you are paying yourself like $50 per hour or $100 per hour. It might be reasonable. So reasonable has to do with comparing. We need to compare that reasonable with multiple things. One thing is comparing yourself with somebody that if you were to hire, do the same thing, how much you have to pay. I'm very sure if you hire somebody to do what you are doing, you're not going to pay 10,000, right? Because that person will not work for you. So that is what is reasonable compensation. So that is one of the drawbacks on the corporation. Okay, it has their benefits, but it also have the limitation.
So if you pay yourself, then you have to pay the withholding all of the employee tax, all of that.
Yes, basically the question, if you pay yourself, then you have to pay withholding and all of that kind of stuff. Yes, think about, it's not bad. Think about this way. Thinking about the S Corp, about the 100,000, right? So let's say 50,000. Let's assume 50,000 is a reasonable compensation. So if I pay myself 50,000, I know that I have to pay income taxes. So if I am paying myself as an employee, I will be withholding that already, kind of prepaid, right? So I'm done. I already paid that, fine. Self-employment taxes, you also have to pay, right? Because you are an employee, so by force, you have to pay it. So technically, if you are an LLC, you have to pay self-employment taxes plus income tax, right? As an employee, what you have to pay? You have to pay also income tax and self-employment taxes. So there is no difference between those two. As an employee, what you are doing as an employee, you are just prepaying for those taxes that otherwise at the end of the year you will have to pay as an LLC. Because remember, LLC, you don't pay taxes. You are supposed to pay estimate taxes because if you know how much money you are going to make, but it's coming from your pocket. So on the LLC, there is no difference between those two. As an employee and as an owner of the LLC, there is no difference. One of the benefits about the C corporation is that nobody knows you have a corporation because it doesn't go through your personal taxes, right? You can have like 10 corporations and everybody thinks you are totally broke, but maybe those corporations, each of them is like $1 million. So nobody knows. It's anonymous. Okay? Then you also have the asset protection. It's just like the LLC. Versus the other form of structure, this one is the easier to raise capital because you can sell a stock. Okay? With the LLC, you cannot sell a stock because you are a member. But with this one, you can just say, we need money, bang. Let's sell a couple of stocks, see how much people want to pay. That's it. And with the LLC, basically, you have to, you will have something called operating agreement, which is going to have some limitation between you and your partner. And there is not much you can do. If the agreement says you cannot invite other members, that's it. And the biggest difference between corporation and LLC is life. Corporation can last forever. LLC, sometimes it will not last too long. If you and your partner are the members of the LLC, if the other guy die, then that's it. The LLC is finished. The business will not disappear. It's just like, in definition, it's finished, and then you need to start something new.
So you're saying that if your partner dies at an LLC, you have to come up with a new name?
Well, it just depends what name you have. You might need to come up with a new entity. Because the LLC established between two people. And when one of them dies, the LLC will stop.
So that person the person who's living would have to.
Well, depend on the operating agreement. Because the contract, right, it's not like, oh, my partner passed away and then I'm going to keep everything that the business has. So there will be some kind of structure, like let's say if the business, my partner die, then whatever the business has, then we need to divide it or something like that. So there is some limitation in that. Sometimes you cannot the partner die and then you pass it to the spouse and then you continue. Okay, they have their limitation. Okay, so remember we talked about double taxation. One of the things is about time and money. When you have a corporation, sometimes you need to fill out what is called board minutes. You have to have shareholder minutes and keep track of all those paperwork. And also, if you have an LLC or corporation, then you need to be filing biannual report with the Secretary of State to let them know that you are still active. And also, if you don't have activity, you have to file your taxes. So let's say you open the corporation, and this year you have activity and you file your taxes. Next year you don't have anything. It's zero. Then you say, well, I don't have any activity, then I'm not going to file my taxes. No, with corporation you have to. You always have to file taxes because the government do not know if you are active or you just decide not to file taxes. So that's why you always have to file. If you are Soleprop, there is no requirement. But if you are a corporation or if you are a multi-member, then you have to file it. So they know that you didn't have any activity for this year and that is supposed to be zero.
So I just want to make sure I understand. So corporation and multi-member LLC, what about a single member LLC?
No, because it's a Schedule C. So the question is that if you are a corporation and LLC, then you have to file zero. But what about if you are just one member LLC? Because that is a Schedule C. Then if there is one, there is no requirement for that.
So you're saying with an LLC, if you don't make anything, you don't have to file?
If there is one owner. But remember, because there is two, there is a 1065. There is more than one member, right? So that is one of the different. Let's move to our last slide that I have here. So let's say, for example, let's say you are in the business, the Schedule C or LLC, right? You can move always. One of the difference is that you have to incorporate first or file organization formation. So if you have an LLC, you can move the LLC to a corporation, either a C or a S. But if you are a Soleprop, you cannot move. You first have to establish yourself as an LLC or as a corporation. So let's say, for example, you and your wife or husband want to start a business and you want to be 50-50. And you want to have control, right? So everybody is going to file their own taxes and that kind of stuff. So maybe the best option is an LLC. One thing that people don't know is about Schedule C or LLC is about hiring your own kids. Okay, so what happens is that when you hire your own kids, when you hire your kid, if the amount is below, let's say, $6,300, they don't have to pay taxes, and you can still claim it as a dependent. So the benefit with a Schedule C as a sole prop or as an LLC, the LLC, the member have to be mom and dad. It cannot be mom and dad and a stranger. So if you mom and dad have an LLC and you hire your kid, you can pay them, right? They don't have to pay they don't have to pay taxes. They don't have to pay self-employment tax. Huge benefit. So you will have the deduction. So let's say you hire your kid, he's 17 years old, you pay $5,000. $5,000 will be a deduction in the business. You don't have to pay income tax. The kids, right, because it's below the threshold. They don't have to pay unemployment tax. Of course, they cannot claim unemployment because they are not paying. And they don't have to pay self-employment tax. Huge benefits. You pay your kid $5,000, it's kind of like free. Of course, you have to have some kind of argument for that, right? So if you hire your kid, you really have to hire your kid, right? And it has to be in something that is acceptable. You cannot say that, oh, I hired my kid, I pay him $5,000 and he's my chef. It's like, oh, okay. It has to be something that is legal and proper, okay? So LLC to S Corp, let's say we have a different in function, reasonable salary. So if you have an LLC to a S Corp, you can do that. Let's say we have 5 members right now. So we want to move to a S Corporation and pay the active partner or the active person a salary. So that will be fixed. You pay that person, and then on the S Corp, whatever profit we have, then it's going to be passive income. With a C Corp, the C Corp allows you to have a fiscal year. What is a fiscal year? Is the one that do not end on December. So let's say maybe you want to have a corporation with a fiscal year ending on June 30th. And then every June passed, then you have 3 months to file your taxes and that kind of stuff. So it doesn't have to be a calendar. If you are an LLC, or if you are an LLC or you are S Corp, you have to be on calendar. Because the pass-through, right? There is no way that how you're going to file your taxes. Otherwise, it's going to be very complicated. Among all of these, there are some difference. You might say that why people will select one and will not select the other one. There are so many things. For example, on real estate, if you have a real estate business, you can only have either corporation or LLC. If you have a S Corp, most of the income is coming from the passive investment, then you cannot, because they have limitation. Okay. Also, if you have shareholders that, that they are not resident, U.S. resident, and they want to invest in the U.S., they cannot be a sole prop, right? Because they are not from U.S. So let's say if I'm coming from China, I just want to invest in the U.S., then I cannot be a S, because S required to be a citizen or resident. So my only choice might be either a corporation or an LLC as a passive, right? So some of the advantage and disadvantage of all of this is that, for example, sometimes you might have a license that require you to be a resident, right? But if you open it under a corporation, then the license or permit is going to be under the corporation, so there is not that kind of requirement. Okay, that is more for people that they want to invest in the U.S., but they are not resident. Yes.
So you said that people can switch their tax structure.
Yes.
Anytime?
There is a time limit. Okay, the government don't want you to wait until the end of the year and you figure out this one is better, and then change it. So the limitation is that you have to do it, let's say, in this year, 2016. If we want next year, okay, when we are filing the taxes for 2016, let's say if we are making the switch March 15, before the due date of the corporation, let's say. Remember, corporation was due date March 15, so I need to do the election. In this case, we call it classification of the entity by that day. Otherwise, they might not approve it.
And so you probably can't flip-flop within the same year, or
They have a limit.
like you could go from an LLC to an S corp and back again.
They
Like
have
subsequent years?
they have a limitation. They don't allow you to back and forth and all of that kind of stuff. So they have the limitation.
And at the beginning, you said something about you can't switch if you're sole prop, or like you first have to file taxes.
Yes, for example, if you are a sole prop and you say, hey, I'm a sole prop, and the question was, can you switch all the time? And then was also between if you are sole prop, can you switch to be a corporation? Sole prop, you cannot switch anywhere because you are sole prop. It's under your name. So basically, you need to be an LLC or a corporation, and then you can switch around.
But you can switch from being a sole prop to being an LLC.
Well, you will have to establish. You have to form and register with the state and the IRS to be that kind of entity. Okay, I think people have been asking questions.
For the sole prop, can you work with your husband together?
Oh.
Let's say I just want to do a simple food testing and see if it's going to work out.
Yeah,
Can my husband help me?
yeah. You will be filing taxes together anyway,
Yeah,
so it will not make any.
so just schedule C.
Yeah, a Schedule C. Yep. So as a sole prop, a Schedule C. That's it. Very simple. Yes.
You have two questions. Is that, when you're talking about your kids, is it just your immediate kids? How about grandchildren or other family?
That one so the question is that when I was mentioning about hiring kids, is that your own kid or it can be your grandchildren? That one, I will have to get back to you because I'm not very sure on that one. That will take note for that. And if I remember correctly, they say that it can be grandchildren, but I'm not very sure on that one yet. So we probably will announce that in the next workshop.
Similarly, like people helping, what if people volunteer to help you because you're in a business and you're getting started? Do you have to track that and the volunteer hours in any way?
No, but the question is that what about people trying to help you volunteering, right? Is there loss? I mean, they're not gonna get anything.
Yeah.
You don't get a deduction, they don't get an income. Just remember about the tax system, how that works. If I am deducting something as an expense, somebody has to claim it as an income. If somebody is volunteering, that person is not getting anything. If you pay that person, it's gonna be your expense, and that person will have to claim an income, right? So it's just moving the money around, I guess. So if it is volunteer, you are not giving anything, there is nothing. In that kind of sense.
Is there like a amount, like I feel like I read that like if they make under $600 a year, but then you don't have to pay them as, like that they don't have to claim that as employment, is that true?
So the question was if there is an amount, and it was about $600. So what happened is that we are talking about not as an employee, we are talking more as a casual labor or contract labor, people helping you that they are no employee. Because as an employee, if you pay $10, you have to do a W-2, right? You have to file it. But as a person that is a contract labor or casual labor, let's say, and you pay less than $600 through the year, there is no filing requirement. Like you don't need to issue any form. So you might have 20 people that you pay $500. You don't need to issue any kind of form to that person.
But they shouldn't report.
More likely depend on, they are supposed to report because the tax system say you have to report everything that is kind of income. So they might not end up paying taxes just because the amount is so small. So we don't know. So that will depend on each individual side. Mm-hmm. Okay, any other questions?
Your company is a LLC?
The question is what kind of company we are. We are a corporation, Community CPA and Associate Inc. So we are a corporation. Normally in our profession, when you deal with professional company, you don't see Inc. alone. You will hear more about PC, which stands for Professional Corporation. In the old time, a lot of people decide to go with a professional corporation PC. Now they're moving away from those because there is no benefits. Professional corporation, they pay kind of flat taxes, which is 35%. And also they have their benefit and limitation. One of them is that when you see the PC, you know that everybody have the license, they are being regulated because the professional, right, designation. So if you see a Inc. or LLC, you might not sure if they have the license or not. So in the past, lawyers, hospital, and all of those, like doctor, they would have the PC to let you know that it was a professional corporation at that time. We don't see many of those anymore. Normally, for law firm, they might be doing LLP or LLC, those kind of company.
And so going back to you, somebody that started the corporation,
Mm-hmm.
and you being an employee under that corporation,
Yep.
it goes back to you would pay your income tax as well as self-employment tax as well, or is that the person who started the corporation?
Well, the question is about if the person that started a corporation is the one paying the tax or the employee, something like that, right? Close to that. Just remember, when we talk about corporation, if it is a C corporation, it's the shareholder. If it is a S corporation, it's the shareholder. So when you say the person started, I will assume that is the shareholder, the person that started. So if the shareholder is the one starting the business, and that person still hold ownership, then that person will pay taxes, either get it as a dividend in a C Corp or on the S Corp, we call it distribution.
And so for someone like you working for that company,
Well, if we are somebody like me, which let's say as an employee, then nothing to do with that because it's just as an employee, right? But as a shareholder, then whatever is my percentage, then I will be paying taxes based on that.
so the employee like yourself, you're just paying regular income tax.
As an employee, just normal. There is no difference between any of those, right? But as a shareholder, 15%, 25%, whatever profit the business has, then I will report it under my personal taxes plus whatever W-2, which is, for as an employee working for the business.
For LLC, on the company name, you have to have LLC on it.
So the question is for the LLC, if you have to have the LLC, and yes, if you are going to have any of these kind of designation, at the end, you have to indicate what type. So if you are doing LLC, they will require you to have the LLC, or you can spell it out. If it is a corporation, you can do INC, incorporation, CORP, corporation. You can spell it out or abbreviate, but you have to have it, so to indicate what type of entity you have.
How come we don't see that then on things? Like, I don't know. On everything that, you don't see the ink or the LLC.
So the question is how come we don't see the ink? And here we have it, and you see that normally we are using communitycpa.com, right? So in a business, you don't really have to use your legal name. You can use your sometimes trademark, DBA. It's not required for you to use your legal name because it's advertising. It's just like, like Pepsi, Coca-Cola, or Walmart. Walmart, you don't see Walmart Incorporated or Walmart Corporation or something like that. They use the abbreviation. But if they are doing something legal, let's say I'm going to buy a property or something like that, I'm going to buy this building, they are going to use the legal name. They're not going to use a DBA. It's just like the name McDonald's. Everybody knows McDonald's, but you don't know who is the owner or what type of entity they have, right? You just know the name. So because they use that, they use the name, the DBA or trainer.
You're watching City Channel 4. On TV, online, on demand, on Facebook, and now on the go on your mobile device.